Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. We'll wrap up 2024. Very interesting year in the markets and the economy as a whole. What we have is an economy that has cooled. It's not going to land. It's not going to have a big adjustment. It's not going to really do a lot here in the foreseeable future. A lot of bad news never happened. A lot of really good news happened for a little while and has corrected. GDP is, for the third quarter, is in the threes. It's very likely going to be that way for the fourth quarter. Inflation is cooling. Initial claims of unemployment are undramatic and low. Unemployment is 4.2, right at towards the upper end of what's comfortable. And all the bond yields are less inverted. They're starting to normalize. More of that in a minute. And mortgages are finally recognizing that we're not going back to free money. Yeah, all of that's fundamentally good. Inflation, the only thing that's really keeping inflation going, well, is two things. One, housing is keeping inflation going, and that's more a question of prices not coming down. They're still unaffordable. That's why a lot of the new manufacturing that's going on in housing is all multifamily, because it has to be. Individual is still too expensive, except for that marketplace that's always been able to afford individual housing. So inflation is not going to be near the issue it has in the past. Housing, the blue here, that's under construction. And most of that, if you go back, this goes back to 1973. The housing market has gone through some changes. Most of that's 2008 and then a little COVID, but it is back to where it was. It's just the shift in basic costs, more multifamily, less single family. Prices are not going to come down. But you look at the households, and this goes back to 2003. You look at the households. There was a lot of, the bubble brewing before 2008. A lot of purchases, no document mortgages, all kinds of things. Well, that bubble had to break. Boom, down it comes. Regular normalizing of debt loads and what people can really afford to pay. Then there's a little bit there for COVID, which is pretty accurate, even though that's mostly just bad data. Where we are now is we don't have a consumer that's stressed. We don't have homeowners that are stressed. They're not pulling money out like an ATM, so on and so forth. They're just okay. And there isn't anything here to break or adjust. It's a fairly conservative consumer going forward. And they've started to spend again. New cars, people were waiting for 0% financing, but that's not going to happen. Or they have a little bit of it. So they adjusted, they're out buying. The stock market, and we've talked about this a lot, is a little overvalued. We've had some correction in the last week, and I know those that were anticipating, the Santa rally or the year-end rally, don't bet the farm on that. We're still overvalued. The market will probably come down more. If we do have a little rally in the next few days, yay. It will simply correct in the first quarter next year. We don't want to have a huge correction in the first quarter, but we're a little ahead of earnings. We've talked about that a lot. A lot of people buying bonds. In fact, there's been a lot of money, some $600 billion go into the global bond market, because most people have figured out that the yields are relatively high now. Interest rates everywhere, and the important interest rates, of course, other than the U.S., are going to come down a little bit more, not a lot more. So you better buy these yields while the getting's good. So that's what they're doing. You can get a quality corporate, not a government, but a quality corporate, which is good debt. You can get one of those at 3.5, close to 4. That's good yield for the foreseeable future. And that's exactly what's going on in the marketplace. So the equity market's a tiny bit overvalued. It will come down. Wait for more earnings. The bond market, well, people are out buying yield, which is a reason you buy a bond. You buy it for income, which is the yield. And the yields are okay. They're going to mellow out. They're not going to collapse, and we're not going back to free money. This is a tough graph. unfortunately, it's one of my favorites. You kind of have to read it inside out. This is basically the yields on the 6-month all the way to the 30-year. The red up there in the top has been the 6-month, the short term. The short term 2-week, the T-bill, the cost of money that the Federal Reserve controls. Well, it's been real high and everything else has been real low. Well, that's adjusting. Now they've moved it down to the point where it's getting in the realm of normalizing the yield curve. So short money has lower rates, long money has slightly longer rates. It's not going to be a big gap here, but it's not going to be really corrected till about June next year. But it's getting there. Cost of money, well, it is adjusting. And this is rapidly becoming a more attractive bond market. And there's going to be a lot more activity in it. Not glorious returns, just activity. The other side is, if you watch the Dow, don't anticipate it staying this high very long. Not necessarily the S&P 500, but the Dow Jones Industrial Average. It's a little high. The glory, short-term glory, isn't the U.S. manufacturing doing great? Well, U.S. manufacturing has basically just recovered from being shut down during COVID. It has recovered to the point of where, well, this is where manufacturing normally lies. Car production, chips, some of it has changed a little bit. And the rest of the adjustments that's going on with supply chains and all the rest of that stuff is going to have to wait for earnings. Earnings are everything. The things that have really adjusted now, and then the biggest drop down here is the imports from China, and that's probably pretty accurate. Imports from China and imports from Canada. Canada would be not so much oil or apples and everything else because their crops really had a bad year. It's cold in British Columbia. China is going to stay in the low-end, low-margin into manufacturing where it excels. They're going to compete with India and Indonesia. And the United States is still going to use some of that stuff because that's stuff we are not going to spend time or money manufacturing ourselves. It's cheaper to buy it overseas. But the European Union is critically important that they're new trading profitable partners. The U.S., it's the only place where there's any money. Germany is slowing significantly. It's going to get worse. They're not going to have a great, well, they haven't had a great couple of years, and they're not going to have a great 25. Their big growth market, China, that's over. They're going to have to sell their stuff somewhere else. Well, there's the U.S., but the stuff they sell here, they make here. So Europe, which has been the employer of a lot of countries smaller than Germany, that's going to slow. And they have some big immigrant issues they're going to have to deal with. Simple. This is kind of it. I don't want to dwell on this too much, but we got to wrap up 24 one way or another, and it's this. It's deficit spending. Keep it clear the difference between what you hear a lot in the media about the $38 trillion of national debt. You'll be better off thinking in terms of, well, it really isn't. It's more a question of looking at it as that's the amount of money that's in the system. That's the amount of money that's been put in the system from Treasury. How it got put in the system is here. It's deficit spending. Deficit spending is the arithmetic and the math of how we get inflation. When there is deficit spending like COVID, it's put a lot of money, $4 trillion anyway, into the system, deficit spending. And after 2008, there was a lot of money put in to recover. That is inflationary. That's money that's in the system already that we're paying the freight on, called inflation. Right now, 2024, end of the year, about $1.8 trillion in deficit spending. Just more money left in the system. Some of that is relieving loans. You know, the list goes on and on and on. This current Congress, going forward, the next administration, well, I don't think they have the wherewithal to cut that deficit down to $400 billion a year is a sustainable number for the U.S. That gives you about 2% inflation. We could spend a lot of time in the arithmetic, but it's not bad. 1.8 trillion is way too much. That will keep our inflation in the threes if it continues that way. And that's not good for a $28 trillion economy. This is the issue. Unfortunately, Congress, who controls the purse strings, doesn't have enough discretionary to get rid of this. There's going to have to be subtle increases in revenue, tariffs, Consumer pays those. They can't just cut spending because there isn't enough room. States are going to have to cut because the Fed is going to cut subsidies. The federal budget is going to cut subsidies on things. The federal budget is going to have to cut some things, but it's not going to be enough to bring this down. It will be very intriguing to see if this next presidential administration can make a substantive move on this. This is important. Okay. Well, been an interesting year. It's been a very profitable year in the markets, 2024. Don't anticipate the same thing in 2025. It'll be okay. Shouldn't be any disasters, barring some incident. We're just waiting to see earnings. And the bond market is going to get back to its normal, pretty healthy self with more money, because all these markets have more money. And the private equity side of things, private stock market side of things, and the private credit side of things, the private debt side of things is getting bigger all the time. Watch how the Nordstrom deal comes together. That's taking it private with private equity. That'll be a great example, probably in the first quarter. All right, well, it was a great year, and I hope to see more of you in 2025. Any issues, please send them along. Questions at info@shjwealthadvisors.com. Happy to deal with it. Thanks for joining me.